Guys, today we are going to go through 3 stocks that I believe are a buy before October ends. I'd be buying these heavily throughout October. At the moment, I'm hearing 2 main narratives. One is that the stock market is drastically overvalued, and the other is that we are at an inflection point with AI, and if you're not in, you're going to be left behind. Well, I'm happy to say that in this video, we have got stocks from both sides of the equation. I've got a deep value stock to show you, as well as 2 AI plays. In terms of portfolio management, it's great to have deep value stocks within your portfolio to make sure if we do see significant downside in the market, you own stocks that are already undervalued and therefore do not fall. Protecting yourself from volatility can be a real emotional ease. But we also want to see large gains with AI stocks, especially as some are saying we are at an inflection point with AI. Earnings for some of these stocks only 2 weeks away. Make sure to load the boat early October. For people who think the bull market is over, they're not looking at it right. There are 2 major catalysts that I believe will push the market higher into 2026. The first is that there is an unprecedented amount of money in money market funds, roughly around 7.6 trillion. Now this money is in cash. As the Fed cuts its rates, that cash needs to earn some returns or be eaten by inflation. This money will likely be pushed into the stock market. The second is, of course, AI and the efficiency gains from AI. AI is expected to increase employee productivity by 40% by 2035, and some believe the global AI market is due to 5x by 2030. But when it comes to stocks, you have to pick right, and that is why I'm making this video. So let me show you stocks that I will be buying hand over fist, and let me tell you, this last one has the chance to be a multi-bagger. Now the first stock on my list is Fortinet, ticker symbol FTNT. Now I've placed each of my stocks into a category of stock, and this category for me is a sector outperformance. What do I mean by that? Well, Fortinet are providers of cybersecurity software and hardware, and I believe that the cybersecurity sector is going to outperform the rest of the market. I'll go deeper into that in a moment. My valuation on the stock gives me a 15% CAGR, which is a 2x in 5 years for Fortinet. You can see here that they recently had a huge 30% drop after earnings, and they initiated huge buybacks straight after. This is definitely a stock that I am willing to get involved in. So why has the stock dropped? Well, the Q3 revenue forecast missed the mark and the refresh cycle is underwhelming. What do I mean by that? Well, Fortinet had been touting a larger than normal firewall upgrade cycle for 2025. So this is the hardware that they sell to many companies in order to keep their networks protected with a firewall, and usually there is a refresh cycle whereby Fortinet will not continue servicing their older models, and therefore the companies have to buy a new set of hardware. Now this is usually called an upgrade cycle, and they were touting a larger than normal upgrade cycle. The CFO said approximately 40 to 50% of the way through the 2026 upgrade cycle at the end of the second quarter. So this meant that investors were very disappointed because they expect a faster product revenue growth from the refresh cycle. So here, I know it's very small, but you can see in the red hardware section, the product growth. But as you can see, there was not much of a growth cycle here, and investors were a bit disappointed to hear that 40 to 50% of the refresh cycle was complete. So if they're seeing slower than expected growth, why do I think they're still a buy? There was recently an assessment by the National Cybersecurity Center highlighting the impacts on cyber threats from AI developments between now and 2027. In all of their assessments, they use a likelihood tracker, remote, highly unlikely, all the way up to almost certain, and they've put the effect of artificial intelligence as almost certain. Artificial intelligence will almost certainly continue to make elements of cyber intrusion operations more effective and efficient, leading to an increase in frequency and intensity of cyber threat. There will almost certainly be a digital divide between systems keeping pace with AI-enabled threats and a large proportion that are more vulnerable, making cybersecurity at scale increasingly important to 2027 and beyond. So this is why I think the entire sector is a great play. On top of this, we see that President's research has suggested that the cybersecurity market will grow at a CAGR of 12.6%. So this is the entire market from 301 billion in 2025 up to 878 billion by 2034. Fortinet management have said themselves that we are very confident we'll be able to grow above the market in the next 3 to 5 years, above the 12% with the market growth. I think the management is correct. I think they will be able to grow. They are a cybersecurity company that like their organic growth. They do not really like to do acquisitions. And I think that this is good because they will continue to strive to outperform. Now, lots of people, when it comes to software and cybersecurity, like the rule of 40. This, in this case, is the rule of 45 using the non-GAAP operating margin and revenue growth. And you can see that they've exceeded this for 5 years in a row. If you personally like the rule of 40, which is the EBITDA margin plus the revenue growth, then they are also positive on that above 40. So they are still a great stock with very high margins. So how did I estimate my 15% return from Fortinet? Well, I made some simple revenue assumptions. Now my assumptions are that the revenue will continue at a 13% revenue CAGR. So that's about 0.4% higher than the overall cybersecurity market. It's not much of an ask in my opinion, and I think that it's easily achievable. You can see here on this graph that the minimum that they've ever had is 10%. And they used to perform much greater. They used to have a much faster growth rate. And I think that's part of the reason why there was such a drop. Investors have been expecting very high growth rates. Now, when it comes to margins, my assumption is a 35% free cash flow margin by 2030. And I do believe that they will be able to get to this 35 mark here, which is above the average, just slightly, average of 34.1. And the max they've ever had is 40%. And I really, truly do believe they will be able to reach this 35% margin. When it comes to buybacks, I believe that they will have a minus 1.7 share buybacks per year. You can see here that they average 1.64. I think that they're going to increase that because of the recent drop. I'm going to put 1.7 share buybacks. Now, the free cash flow multiple assumptions, I have made my assumption that they will have a 3.4% free cash flow yield, or if you're a price to free cash flow person, a 29.4 price to free cash flow. You can see here on the chart where that sits. Their average is 3.15%. Now let's remember for free cash flow yield that when the free cash flow yield increases, the stock is more undervalued, and when it decreases, it's valued higher. So when I plug this in to my free cash flow growth calculator, you can see on the left, I plugged in my assumptions with a target free cash flow yield, like I said, of 3.4%. We are looking at a 15.16% return from the current price of $84.40, which is a 15.16% CAGR and a 2x in 5 years. If you think that the free cash flow yield will stay the same, then you're looking at a 17% CAGR. Now, if you are a bit of a doomer and you believe that the free cash flow yield will drastically increase and that the multiple will get re-rated due to slower growth, then you're still looking at a 10% return, 10.7% return, which is probably in line with the overall market. I think that the risk to reward with this stock is pretty good, and I think it's a buy right now. Of course, none of this is financial advice. Do your own research. Moving on to my second pick, and that is Elevance Health, ticker symbol ELV. The category of stock, I put this as a deep value stock. Now, my conservative valuation actually puts this at a 20.58% CAGR, and this is just a crazy value play for me. And I personally have this in the portfolio. Currently sitting at a price of 318.72. My buy price is around the same as well. It's down 40% since last year, and I'll show you why. So what does Elevance Health do? So Elevance Health is an industry juggernaut in US health insurance, second to UNH. You can see here UNH and then closely followed by Elevance Health. The company offers employer, individual, and government-sponsored coverage plans. It also is an emerging player in the pharmacy benefit management, PBM, and other healthcare services. Why has the stock dropped? Well, the higher medical costs and decreased Medicaid memberships are squeezing Elevance's profits. Essentially, during COVID, medical visits were very depressed. They had dropped because less people needed medical attention, and this was good for the stock. This increased their margins. After COVID, there was a rebound, and Elevance did not foresee medical visits increasing to the end of 2024 and 2025. They'd obviously planned for medical visits to kind of stay the same, and for this reason, they had to pay out more on their insurance premiums. They had to pay out more in medical costs, and margins are very thin in this industry, which meant huge effects on profitability. Also, the Medicaid memberships were being slowly redetermined by the government, which meant that they had a slow decrease in memberships in the Medicaid sector. The Medicaid sector is a government-sponsored insurance plan. Now, this is slowly reaching a plateau, and we should start to see growth after the COVID boom return back to normal in Medicaid, but we shall see. The government is currently playing around with some policies with Medicaid, so we're just going to have to wait and see what happens there. That my thesis on the stock assumes margin recovery. Elevance is already repricing their insurance premiums to reflect the increase in medical costs. So the revenue is currently 12% year over year and will likely continue to increase due to the demographics. You can see over here in the year 2000, this is what the demographic spread looked like. You had a lot of the population in the 40 to 35 range, and since then we're at 2020 and all of that population has shifted upwards, and we're looking at a much larger population getting older, meaning there will be increase in revenue due to more people needing medical attention. The net income margins are currently 2.8%, and margins will not instantly rebound, but they will rebound. It's just going to take a little bit of time. Probably into 2026, 2027 is where we'll start actually seeing the growth. But the stock is so underpriced at the moment that it's not taking into account any kind of repricing of their insurance premiums. So my revenue assumptions for the stock is a 7.5% revenue assumption, which is way below the average of 10.27. And of course, I just showed you that revenue will probably accelerate due to the aging population. And yet I've gone for 7.5, which is way lower than the 10% average over the past 7 years. Now, my assumption on margins is that they will have a 3.5% net income margin by 2030. Their average over the past 7 years is 3.82, and they currently sit at 2.8. Like I said a minute ago, all I'm saying is that I reckon they will get up to 3.5, which is around here. Now, my shareholder assumptions, my assumptions are that they will continue to buy back shares at around a 2% share buyback rate per year. The median is 1.9. I do believe they're going to increase this as the stock is undervalued at the minute. In fact, there's already been some insider buys from some of the CFOs and CEOs within Elevance Health. Also, they have a dividend yield of 2% currently, which I just think is outstanding, adding to the returns that you will receive from the stock overall. Now, my assumptions for their PE ratio, their average PE over the past 10 years has been 17.11. They're currently sitting at 13.58. Now, my assumption is that they will get back to a 16, which is still below the average. You can see I have been very conservative here. So here is my EPS growth calculator. I've obviously input what I have just told you, and my results from this with a target PE of 16 is a CAGR plus dividends of 20.58%. Like I said at the beginning, this is around a 2.5x in 5 years, if not slightly more, looking closer towards a 3x. Obviously, if you think that we reprice just back to the average PE, you're looking at a 22.17% CAGR. If you think that we stay at the same PE of 13.4, you're still outperforming the market with 16.52% return from here. This is a deep value play that I strongly believe in. I've invested in myself. If you want access to create custom charts like this one in the video here, you can create these yourself and easily find out averages over the past few years, easily layer on top of each other several different metrics. Then you can use my code STOCKS to get 15% off your Fiscal.ai membership. It will support the channel, of course. Anyway, let's get back to it. Now, the next stock on my list is a Kraken Robotics. Now, a lot of people will have never heard of this stock. You can see here it's done 160% in the last year. Ticker symbol KRKNF. And the category that I put this in is high risk, higher reward. I think that this is a potential multi-bagger, 5x in 5 years. Obviously, this is not financial advice, but I'm going to lay out the thesis as to why Kraken Robotics could be a potential multi-bagger. So what does Kraken Robotics do? Kraken provides advanced underwater sensors, high-resolution sonar, and high-endurance battery power systems that can reach depths of 6,000 meters. These vital components are essential for the next generation of unmanned underwater vehicles, or UUVs, essentially underwater drones. Kraken is involved in many of these projects, including those developed by Anduril. So here you can see one of their drones called Ghost Shark, and it is an Anduril drone, and Kraken Robotics have parts within the Ghost Shark. So why should we pay attention to Anduril? Well, Anduril is disrupting the legacy defense industry by using a Silicon Valley model to rapidly develop high-margin AI-powered autonomous systems. Now, we've all seen drone warfare, all seen in Russia and Ukraine, where drones are just used intensely immense amount of drones are used in that conflict, and some of Anduril's drones are being used in that conflict. Here you can see just how quickly Anduril has scaled up. They're growing their revenue at over 100% year over year, and they have done for the past 5 years. So why is Anduril such a great company? Well, essentially they have a rapid R&D model. Traditional defense sector is very slow, and Anduril provides the defense sector modern technology very quickly, and they do this in a very profitable way through fixed product sales and software as a service. They're focused on AI-powered autonomy. So they're focused on AI and drone technology that runs on real-time decision-making software, Lattice OS. This is their own software. And it takes data from multiple sources, for example, multiple drones in a swarm. So they are winning contracts left, right, and center across the Western world. They are also focused on the affordable mass. They prioritize affordability and production volume over expensive bespoke machinery. The company is investing heavily in their manufacturing facilities in order to just pump out these drones so that if there was a war, they would have the manufacturing capability to pull off the win. So how does Kraken Robotics really relate? What is the thesis? Essentially, Kraken develops the batteries for multiple of Anduril's latest AUVs, autonomous underwater vehicles. Here we can see a report. Anduril is set to open a large-scale production facility for autonomous underwater vehicles. The Rhode Island production facility will enable Anduril to increase production to 200 AUVs per year and create more than 100 jobs in the next 5 years. The factory announcement comes amid growing demand for Anduril's AUVs, including an $18.6 million contract with the US Navy. Now, they since have done a huge contract with Australia of $1.7 billion, but we'll get into that in a minute. So the thesis is that each Anduril AUV contains around 2.5 million of Kraken components. So 200 times 2.5 million. Remember, 200 is the amount of AUVs this Rhode Island production facility can produce per year. 200 times 2.5 million equals 500 million in revenue per year for Kraken. This is 8 times 2024 revenue for Kraken. This is huge explosive growth if this does come to fruition. In the defense industry, you have very high contract stickiness. So in the defense sector, once a technology is integrated and tested in prototypes, switching suppliers becomes extremely costly in time and risk. Navies demand battle-tested gear and won't approve of component swaps that could delay critical programs. So here you can see that Australia is spending 1.7 billion on a fleet of Ghost Shark submarines. Ghost Shark obviously being the drone I just showed you that Kraken provides batteries for. Here you can see one of them in the Australian Royal Navy base in Sydney. So what does their growth look like? If we see Anduril production ramp up in 2026, this is what we could see. You can see here from June 2025, 66.2 million in revenue trailing 12 months. This is in US dollars. You can see it would grow at 2.6 times the amount, up to 160 million, which is incredible rapid growth by 2026. Now bear in mind that this is only 64 units produced in 2026. This is a slow build up in production for Anduril, so I'm taking that into account. And remember, this is not including revenue from other projects that Kraken is engaged in, and believe me, they are engaged in a lot of other projects. This is only a short dive into Kraken Robotics. I recommend doing some of your own research into Kraken Robotics. If you want me to do a deep dive into this stock, just tell me in the comments. But that about wraps up what I'm going to say on Kraken Robotics for now. If the thesis is correct, I expect a 2x in 2 years, and that is with room for further upside. Now here is my portfolio, guys, for any of you that are wondering. It has changed dramatically. I've actually trimmed quite a lot of my HIMS position and put it into some of my smaller positions, including Kraken Robotics and Elevance Health, now making up near 5% of the portfolio. I do want to mention that I'm currently using Trading 212 to trade my stocks and shares in the UK. You could get a free shares up to £100 if you use my invite code I've dropped down in the description below. Also, I want to mention that Elevance Health has run up significantly in price since making this video. I still believe that it will give you outstanding returns. This means that I see about an 18% return from Elevance from this current price of 354. If I had cash, I would still be buying into Elevance. So don't see this as the stock's run up and it's gone. It's gone. If you enjoyed this video, please subscribe to the channel. It would mean a lot. I'm a very small YouTuber trying to grow, and it would mean a lot. So thank you guys for watching, and I'll see you in the next one.
hopping out Ferrari. My house is 3 stories. I'm still independent cause jobs couldn't afford me. The meetings were boring. For real, I was snoring. The VP was fine, yeah, she